So there's a few steps or a few things you need to know before you invest your money. So first, you got to know your balance sheet. You got to know how much do you have in savings and over and above your emergency fund that you can start with. Second, you got to know your budget. You got to know how much you can commit to adding to the portion of a portfolio on a monthly basis. Then you got to know your purpose. What's the money for? It's best if both time and amount are determined before you start investing. So are you building a down payment for a house you're going to purchase in 5 years? Or are you planning for, a retirement income that you can't outlive starting when you're 65 of $40,000 a year? Those will tell you how much risk you can take. If it's something that you're going to use in 3 or 5 years, the risk you can take is much, much smaller than if it's something you're going to use in 30 or 40 years from now. Then you got to know the math. Are you saving enough in addition to these investments that you're going to have enough at those points in time? Finally, you probably have it's really, really important that you know your psychology. So very shortly after you invest this money, the markets are going to decline. If they go down 2% or 10%, you won't be able to know any better if they're going to go down 5% or 15% more. You won't be able to tell when they're going to bottom. You won't be able to tell when they're going to turn back up. This is normal. You just keep adding money until you get to those goals. And then finally, before you invest, you have to open an account at a low-cost brokerage. Maybe that's Vanguard, maybe it's Fidelity. And then you have to start with a broadly diversified, passively managed, low-cost index funds. I want to thank you very much for listening. Be sure to leave any questions you have in the comments. Sign up for the weekly emails to stay up to date, and I'm going to drop a link to that below. Thanks.